As everyone watching this video knows all too well, 2020 was a brutal year for the hospitality sector. But entering 2021, we can see the light at the end of the tunnel. We still have many challenges ahead, to be sure, but there are many factors moving in the right direction. But first, we'll have to cross the chasm of the winter months. January and February are generally slower months for the industry, but the recent pandemic surge will also weigh on hotel demand. The number of new COVID cases is at record levels, and that's causing several states and municipalities to conduct partial lockdowns and tighten travel restrictions. This will likely weigh on hotel performance through the first quarter and perhaps well into the second. But there is help coming. The recently passed $900 billion fiscal stimulus will be an important element. It includes a $284 billion infusion into the Paycheck Protection Program, which will provide many hotel operators with forgivable loans that can help cover staff and operating expenses. In addition, the new rules increase the amount hotel businesses can borrow up to 350% of monthly payroll. There are a lot of nuances to that program, but it could be a valuable lifeline to carry hotels through the winter months. In addition, the stimulus package includes a new round of $600 stimulus checks and revived federal unemployment benefits of $300 per week that will bolster spending. This will help put more cash into the economy and potentially drive some leisure travel. The stimulus also includes another $15 billion for airlines to keep those companies operational until air travel revives. This will be important to the hotel sector over the longer term. So although a full recovery will require getting control over the pandemic, the new stimulus will be an important ingredient in sustaining the economy until we get there. Then, of course, there are the vaccines, which are finally making their way to the populace. Getting the US population to a critical mass of vaccinations will ultimately be the key ingredient to a full recovery. And it looks like we'll reach that tipping point sometime in the second half of this year. But once we get there, once 70% or more of the population has been vaccinated, it will unlock a lot of consumption and a lot more travel. There's about $16 trillion in US savings deposits right now. That's $2.5 trillion more than normal. Once people can move more freely, a lot of the excess savings will likely be spent, almost like another round of stimulus. And a significant portion will likely be dedicated to travel, giving the sector a quick boost. Of course, this will not lead to an across-the-board snapback in hotel demand. But in the second half of 2021, assuming there are no major setbacks, occupancy rates should begin their recovery. It's still too early to deliver a reliable hotel performance forecast. The range of variables in play and the significant variance between markets and hotel subtypes greatly diminish the value of a broad macro level forecast. So shifting gears, from an investment standpoint, hotel sales activity has been very limited. In the second quarter of 2020, sales were down by as much as 80% on a year-over-year basis. The third quarter was modestly more active, and it looks like the fourth quarter of 2020 was better still. But sales activity is still down by about half from 2019. Again, there's tremendous variance in pricing depending on the assets, the chain scale it serves, the location, etc. In general, there is modest upward pressure on cap rates, but the revenue declines is where you see the majority of the loss in value. That's why the transaction velocity is low. RevPAR is only down temporarily, so most investors are trying to hold until we can get to the other side of this. That's also why so few truly distressed assets will come to market. Most properties that face foreclosure will be held by the owner or the lien holder until the market recovers. So that brings us to our guidance on 2021. My best recommendation to hotel investors is to conduct a granular review of each asset they own. Model the recovery period and burn rate for each property, and at the same time, get a current valuation estimate. Then you'll be able to make a better hold or sell decision for each property. Most investors want to hold all of their properties if they can, and I understand that. But that might not be the best strategy right now. The decision should be based on an analysis of the assets and the potential return on equity today, rather than based on the original acquisition price or the original investment plan. A recovery is in process. It will likely take 6 to 18 months to get rolling depending on the asset. So the real question is whether freeing up and reallocating capital is a better option than feeding the property for an extended period. Once we do get to the other side of this, the economic outlook and potential hotel demand is reasonably strong. So unlike the recovery from the global financial crisis, when the economy languished for years, then made a slow climb back, we will likely see a more aggressive pace of growth, and that will be good for the hotel sector.